Hey everyone, hope everything is going well. All right, I wanted to touch base on Janet Yellen. Janet Yellen is the head of the Treasury, and she used to run the Federal Reserve. And when you see them say something that may be perceived as negative, that's something you want to look at because they want to be as positive as possible because this is a confidence game. Yellen sees more commercial real estate stress losses, but no systemic banking risk. She can't say that there's going to be a systemic banking risk, but back of their heads, I do think that Yellen probably thinks that, but she can't admit that because that could create a bank run. And then it talks about Yellen, what she told the Senate Bank Committee. Let's read this. Yellen told the Senate Bank Committee hearing that the bank regulators are working with banks to address risk caused by higher post-pandemic vacancy rates for many office buildings in larger cities and higher interest rates for refinancing loans. Valuations are falling. It's so obvious that there's going to be stress and the losses are associated with this. I hope and believe this will not end up being a systemic risk to the banking system. The exposure of the largest banks is quite low, but there may be smaller banks that are stressed by these developments. She did not address the stock market sell-off experienced by New York Community Bank, which last week reported a surprise fourth quarter loss after building bigger provisions for potential commercial real estate loan default. Wow, that's interesting. And if you just look at uh I think it's Avi Gilbert, Safer Bank. Let's see this. Safer Bank research articles. He talks a lot about the CREs over here, and he goes into all the ins and outs. And all of you should be looking at this website right now because we have a lot of issues. And he talks a little bit about what's going on with this particular bank and other banks as well. Let's take a look at this. And he's just talking about even his parents. And he's convincing his parents to move his money to a bank that's most likely safe. And I'm going to read a little bit about Deutsche Bank. Okay. Deutsche Bank also reported fourth quarter results last week. The bank's loss provisions were the highest since second quarter of 2020, mainly due to U.S. CRE loans. As the chart below shows, U.S. CRE CLP is almost double in Q4 compared to Q3. Furthermore, Deutsche Bank made the following comment regarding U.S. CRE space, which looks quite concerning. Refinancing remains main risk when loans with lower debt service coverage ratio and reduced collateral values reach maturity extension dates, often requiring modifications, including additional equity to qualify for refinancing. It may sound quite unexpected, but even Asian banks started to post losses due to US CRE lending. Japan's Azora Bank announced that it would post its first annual loss since 2009 due to massive provisions that the banks booked due to a deterioration of US CRE credit portfolio. The bank's share price fell about 20%. Another concerning study came from the IMF. The agency has published a report saying that the US CRE real estate is currently seeing an unprecedented fall in prices. And then it shows it's the steepest in the last half a century. This is also quite interesting. You'd like to highlight the US banking regulators have changed its rhetoric regarding the banking system. The FDIC, which is usually optimistic about the banking sector and prefers to ignore red flags, has recently made the following statement. Looking more closely at the CRE portfolios, we're beginning to see concerning trends in non-owner occupied property loans. The volume of non-current, non-owner occupied CRE loans increased by 4.1 billion or 36.4% quarter over quarter. In addition, these loans had a non-current rate of 1.3% in the third quarter, up from 0.96% last quarter and 0.5% a year ago. This is the highest non-current rate reported for this loan portfolio since third quarter 2014. In addition, the Fed removed the phrase "the banking system is sound and resilient" from its latest FOMC. Moreover, Jerome Powell stated that the commercial real estate feels like a problem we'll be working on for years. It's a sizable problem. These changes in rhetoric from the FDIC and Fed may suggest that the regulators are gradually preparing markets and depositors for a banking crisis, which is likely imminent. Okay, this is Avi Gilbert. Avi Gilbert was very optimistic about the economy. He's been more right than wrong. Okay. And I follow this guy very closely. And the fact that he's harping on this and he's a technical analyst and he's pounding the door on the commercial real estate situation, this is a situation you should not take lightly. If nothing happens, that's great. We can move on, but prepare. Look at banks that have great balance sheets. And I'm not going to tell you what bank to look at, but regional banks, I would not have my money in there whatsoever. Whatsoever that's exposed to commercial real estate. Okay. Anyways, let me know your thoughts on this, and I'll talk to you later. See ya. Bye.